If your goal is to come in and write 2 to 3 checks, maybe invest in 4 companies and move on, don't do it. That model doesn't work. What the model that works is you got to invest in 20-something companies. And that historic data says that those investors are going to generate 27.5% IRR return, which is a great return on your investment, but only if you truly diversify.
How big are the checks are they writing? Is it $5,000? Is it $50,000? Is it $5 million?
So it depends on the angel network and the angel, but typically we see them writing checks from 10 to 25 to maybe 150, maybe 250. Occasionally you'll see somebody write a $500,000 check, but most of them are sort of in the 25 to 150K range.
What is 10 to 15,000 going to do? Cover payroll?
Take 2 to 3% of your net worth and then take whatever that dollar amount is and spread that over 20 to 30 companies. 3 investments, you're probably going to lose all your money.
The Venture Capital Show is sponsored by It's a Consulting. It's a Consulting is a one-stop shop for emerging VC funds and their portfolio companies, offering financial operations, investor reporting, and controller CFO advisory services, all under one roof.
Trey Bowles, thank you so much for being here. Right out of the gate, what is a venture studio?
That's a great question. And I think a lot of people don't know the difference between a venture capital fund or a studio. And so we define venture studio for us in a certain way. There's lots of different ways you could define venture studio and how they work and what they do. But for us at 1845 Ventures, we co-found companies with founders. And so that means at a very early stage, we are entering an agreement with them as equal partners. And we are coming to the table and we are helping them take their idea and build it, grow it, and exit it. And so we come in and we help all the things that an entrepreneur, most likely a first-time entrepreneur, doesn't know how to do. And I always tell people the reason companies fail isn't because founders aren't solving real problems or they've got bad ideas. It's because it's 25 different things you have to do and you know how to do one of them. And entrepreneurs spend so much time trying to figure out how to do some of those little elements to make them work, and they run out of time and they run out of money. And so we come alongside, my business partner Ryan Brown and I come alongside and help them by bringing all of that elements to the table that they need. We call it shared services. From we legally structure the business, we raise the money, we pull together the back end systems and bring together all the groups that they need to work with, from accountants and CFOs to attorneys and design and development firms. So we're really just bringing our experience the last 20 plus years to bear for these companies as we start build them and grow them. But we're operators. We're not writing a check and saying good luck. We're in the business every day, especially in the beginning, helping them build and grow. As I tell the founders, one day I might be making a sales call for you. The next day I may be sweeping up the office. I'm doing whatever we need to do to make this work.
So who pays for that though?
Who pays for the venture studio, or who pays for the?
So like I have ABC company.
Right.
I know I need help.
Yes.
I call you up and hey, let's you like, man, you have a great ABC studio. ABC company is the best ever.
Right.
Let's come together. What do you have? How much dry powder you have? And I'm like, I don't know. I've got like $10,000. I have $100,000. I have $1 million. That gives me a 6-month run rate with my current whatever. And I'm making everything up.
Right. So we come in and we partner from an equity position with the company, and then we raise the money. So we don't have a fund necessarily like a traditional venture capitalist fund. We go out and raise money direct into every single one of our portfolio companies.
So like you're coming in with the back office, et cetera, but in order to pay for all that, you're going, hey, it's going to cost, we project it's going to cost X to do that. But obviously we can't just raise X, we need to raise Y. So it's not just us, but also the further expansion. And that's when you go out and raise the capital,
right,
for fund to kind of fulfill that.
Yeah. And the way that we originally set up 1845 is we went out and found strategic investors, about 35 investors that we let invest into 1845 directly. And for that, what they get is they get one investment in 1845 gets them an investment in every single company that we invest in. So call that 15 companies they're going to get for one investment. Second of all, they get the right of first refusal of any company at any round if they want to invest in it. So it's very friendly to accredited angel investors. Not a lot of venture capitals firms are going to invest in this type of deal. The other thing which I think is really unique about our particular venture studio is our model. People often ask you, well, what market focus or verticals are you looking for when you invest in companies? We're very agnostic. Between me and my business partner, we've built companies in a lot of different spaces, somewhere around 50 companies between the two of us. And so we've seen and dealt with a lot of companies, and then with my involvement at the deck, I worked with 10,000 companies there, so I got to see so many different companies in so many different markets. What I realized was I'm not as worried about what market you're in. I'm going to bring people around us that are subject matter experts, that are mentors, that are advisors that can come in and help you grow. What we're focused on is what we think is a model that fits Texas. Texas doesn't have a lot of billion-dollar tech exits, but it does have lots and lots of $100 to $300 million exits. And so our model at 1845 is we're going to invest or raise $2 to $3 million per company, and then our goal is to exit that company within 3 to 4 years at 50 to 150 million. So when we start 50-50 partnered with a company, some people think that's a lot of equity to take. We would argue we're contributing a massive amount of the value, but in our model, the founder has about 30% stake in the company at exit versus a traditional venture capital initiative where you may have 5 to 10 tops. But because of the capital efficiency of how we use capital and how we grow those companies, it becomes really interesting. And why that's so good in Texas is the companies that are getting bought in Texas, or for the $100 to $300 million acquisition, are getting bought by corporations in Texas. And they will pay that kind of money any day of the week to solve a problem that they have. It's not a lot of money. It's not even enough money for them to write a press release, which is why we don't see a lot of those exits in the media, is because they're like, that's a $200 million buy. I'm not going to put that in the media. That's too small. I'll put it in my,
Newsletter.
yeah, or my end of the year report, right? Whatever it may be. And so for us, that's how we're picking companies here. We have a very specific process we go through in due diligence. And part of that is, as we're looking at potential investments in companies, we're talking to potential acquirers at the same time. Do you sense this problem? Do you have this problem? If we solve this problem, would this be something you'd pay for, invest in, and or purchase? And so that's an important part of what we do. So in our model, one of the 4 companies we currently have was created by my business partner. It was his idea, but the rest of them, we're finding founders and co-founding with them.
Well, it's interesting because, I could see both sides. Like, how would somebody give up so much equity for no money? But being that, I've been running this business for 6 years, and I would love oh, you're going to come in and help solve all these problems that I know I have, and some of the problems I don't even know I have.
Right.
And then you're also going to put an evaluation and help raise, and then I get to just keep doing what I'm doing. Like, that aspect, I think it goes back to on the startup community, especially around SMU, they don't really understand how painful it is to be an entrepreneur. Because obviously if you're at SMU, there's probably some sort of affluence attached to it. But if you're blue collar, or if you don't have external support, it is incredibly painful, stressful, all the above.
Absolutely. And this model isn't for everybody. Some people come in and say, I think you're taking too much equity. Our answer is, well, then this is obviously not the right place for you. And I would assume if a company had raised a bunch of money or was generating a bunch of revenue, or an entrepreneur who'd built 3 or 4 companies, they wouldn't need to partner with us in that way. But for the first-time entrepreneur, or for an entrepreneur that's in a distress situation, or commercializing IP out of a university, like, that's super valuable to them, because again, companies fail because they don't know how to do the 25 other things. The one thing that they want to do and be able to do is the one thing that they're really good at. They're at solving a problem. We want them to be able to focus on solving the problem while we're setting up their accounting system, right?
Right.
While we're going out and talking to investors about why this is such a great opportunity. While they're helping design and develop what the product's going to be and do, we're helping bring those resources to them. So it allows us to do something that we just really, really love, which is being operators and building companies. And so we get to marry the concept of being an investor with the concept of being an entrepreneur and bring together, the assets we have to make companies succeed.
And I can imagine your history in the venture entrepreneur space, because you're stepping in, and I don't intend to make this a commercial for you, but it's probably going to come out like that. But because you're stepping in and giving that back office, one, you probably already have relationships with potential investors. You're probably going to lower that risk profile, which in turn makes it to where when they're not stepping in saying, "Hey, I want 95% of this company for this check,"
Right.
and you can have a little bit more stronger terms for the founder and for yourself.
Yeah, our terms are pretty straightforward. We have really fair valuations and value caps, and we give our investors in 1845 again get right of first refusal, so they get a chance to see every deal before we take it out to the public, and they can write, a pretty small check and still be involved in some capacity. In addition to the fact that because they invested in 1845, they've got equity in every company that we build anyway, and it was a very intentional model, very intentional in terms of only taking a certain number of investors. Because we wanted people who wanted to be involved in helping companies grow and who were able to do that. They could be mentors, they could be advisors, they could be connectors and investors at the same time. So so far for us, it's been a great model. We're learning a lot, as you would in anything you build and anything new. But for me, it was just a better model than building a venture capital firm and trying to raise a fund.
Right.
And same for Ryan. So we're really bullish not only about what we think this opportunity provides for us and for 1845, but we're bullish on Texas. We're bullish on DFW. We think the world is moving here. We think in 10 years, DFW and Texas will be the top one or two commerce hub in the U.S. And you can see that by all the activity that's happening, and it's not slowing down. It's just getting faster. And so it's a great time to be a Texan, and it's a great time to build a company here.
So what do you think your capacity at 1845 is for companies to partner with?
We typically, as of right now, we're looking at making 3 to 5 investments a year.
Okay.
We have 4 partners right now for 2026.
So you actually call it an investment versus a partnership?
It's both. Yeah,
Okay.
it's a partnership. I mean, we're literally co-founders. 1845 is a co-founder in every company.
Okay.
So we're on the cap table. We're actively involved. Our team is actively involved in every component of their business to help in any way we can. But we want the founders to run the company. We believe that they should be the ones running the company. We're just there to help in any way we can in any capacity until it gets up and running at a place that we can have the money to hire the rest of a team and really begin to grow the business.
Do you prefer revenue generating, pre-revenue, post-revenue?
Well, so, I mean, we would prefer fully funded revenue generating companies. That's probably not the type of company that's going to be interested in our model. But I mean, the 4 companies we have right now we're all basically not even incorporated yet. So they had ideas. One of the things we spend a lot of time on is this, customer solution validation process. And so one of the things when I hear people say, well, I can't start a business, it costs too much money and it takes too much time, or I've got to raise $1 million, my answer is there's 3 things that you can do that cost no money. The first one is you can go talk to potential customers. Am I talking to the right person? Does this person feel the problem that I'm trying to solve? Is it this person? Is it a different person? Like going out and spending time really uncovering who your customer is the first step. Second, showing your solution to them, right? Proposing them. Here's the solution to the problem that you have. Does it solve that problem? And we're in a world today with AI where nobody can't have a prototype, right? It's just too easy to have something that you can show somebody, even if it's not a full product. You could say, this is what my product's going to do and how it's going to work. And so the second phase is, does my solution solve your problem? And the third phase is, will you buy it? Will you pay for it? And if so, how much? Those are things we expect every company to have when they work with us before we'll make an investment. And that doesn't mean they've always done it when we first meet them, but we absolutely go through that process, and we help them go through that process during the due diligence phase, just to make sure there's actually a product that solves a problem that has a market.
What about personality?
That's exceptionally important. I mean, I think especially at that phase, the most important part of the investment is the founder, the founding team. Do we believe in him or her? Do we believe that they can, that they're coachable, that they'll listen, that they will take advantage of what we're bringing to the table? Some of which is these mentors and these advisors, these subject matter experts who can help them succeed. We're bringing that in. If they aren't coachable, we won't invest in them. Do they have subject matter expertise in the area, right? Do we think they have the conviction to stick with this? You talked about it before, but building a company is hard, and most people have no idea what that means. They may think they know how to work hard, but until you've built a company, you don't really know what that looks like. And so we, looking at these founders, have to say, are they going to quit? Like, when they realize how hard this is, are they going to quit? How strong is that conviction? How important is that passion? And what's the likelihood they're going to stay with it? So there's a bunch of factors around the person that comes into play, but at the level and the stage that we're investing, there's nothing more important than the founder themselves.
It's funny that the topic of quitting, or when it's over, when does a company fail? Because I would assume most people would think that a company is over when it runs out of money, and it's like, no, you'd be surprised how long you can run a company with no money and negative money.
Right.
It's a little bit of a shell game, and it's incredibly stressful.
Mm-hmm.
And obviously, I'm not speaking from experience at all, but it is what it is. But it's I think Alex Hormozy has spoken about it before. But a company fails when it runs out of founder energy, because you can have $100 million, but if the founder has no more energy, the company's done. You know?
It's true. Yeah, and the founder is important, especially in the beginning.
So you spoke about being agnostic in the industries and the sectors, but what excites you? What is it that you want to be a part of? So like, obviously, if I have ABC company and you're like, it works, I like you, let's go. But what if what's the shiny object that you're like, man, I really want that?
So for us, it's the exit strategy. Does it fit our model? Can this company with $2 to $3 million get to a valuation of 50 to 150 million? Which
in a 2 to 3,
in a 3 to 4,
5?
3 to 4 year range. And so things that are important are, we're not going to, if the company is going to require $20-30 million in ad buys to grow and build an online presence to sell direct to consumer, then that's not a great fit, right? That doesn't mean we don't have direct to consumer products, because we do, but we believe through network partnerships, through distribution channels and plans, we believe that we can take these companies and grow them a different way than rather than just online ad triage, where it's about acquisition cost and lifetime value. Even though those are going to be important components, that's not the model. And so when we're looking at them, we're looking at it saying, does it fit our model? Do we think it can grow? Do we believe it's going to get to this revenue number, which based on the multiples have this exit component to it? If we believe that can happen, that's a company we get excited about.
And is it B2B, B2C, all the above?
It's been all the above. At this point, we have some B2B2C, we've got B2B, we've got B2C. And so, but they all fit inside of that model that we're trying to build. And we've got some pretty amazing founders that we get to work with, and that we're excited about coming to work every day because we believe in them, and we believe they can accomplish the kind of stuff that we're going to accomplish, and they agree with us on the vision, right? You can't have two founders, one that says I'm only going to sell if it's $1 billion, and one who says we're going to sell at 100 million. That doesn't work. So our founders are in lockstep with us in terms of our strategy and our goal and where we're going to take them.
And you said you were, if I heard you correctly, 5 a year or 5 total?
3 to 5 a year.
Okay.
Is what we would like to do in terms of investing and partnering and growing these businesses.
And then with you and Ryan, your partner, you were saying that y'all will be in there sweeping the floors if need be. What happens in 3 years' time when you have 12 to 15 companies? Is it just, hey, we've got enough team and we've put the right team in place, and then you're just doing drop-ins? But how do you keep that involvement when you scale?
So, I mean, a part of it is our team will grow as we scale. Their team will grow as we scale, and we're still going to be involved. We're going to be involved where they need us. And if we build the right team, if we help them build the right team, if we equip them as leaders to grow a company well, then they shouldn't need us on a daily basis. They should need us on a, hey, this broke, what do I do? And that's where we easily can come in and say, oh yeah, I've broke that before. Let me help you. That's where all those mistakes and errors you make at a young entrepreneur, or as a growing entrepreneur, or even as a mistake that I might have made this morning. Like, you just learn from those, and that's really adds value to an entrepreneur, just to know that you're there and you can help solve problems. That doesn't mean they need us to run, Salesforce campaigns or HubSpot sequences, right? They should fill that with people that they can hire and bring in. And so the goal would be the 4 we're working with now, next year, start to grow, start to generate revenue, start to hire a team, which gives us a lot more time to focus on the next 3 to 5 companies. Still be back and forth with the ones that we have, but these are our companies that we have a lot of ownership in, and we're not going to have 50 companies, and we're making a pretty large investment in each of them, so we have to stay involved.
And how are you paid throughout? Is 1845 the investors that funded that? Is your management team taking salaries out of there, or are you also taking distributions or salaries or payments from the companies that you're involved in?
Yeah, so our revenue model is a shared service model. So we take a small fee for the services that we're providing. And over time, that number grows as the success of the company grows. And so it's never a number where you feel like it's a material load on the company. But it is something that we're doing, and we're earning that money right now, even though it may not be paid till later, because the time where we're the most involved and the most engaged is the time when they have the least amount of money. And so you have to build it up, and then over time it just kind of pays out as a distribution and dividend there, like a consulting fee or shared services fee. And then the end goal for us is that we're living off the distributions of exits that we help accomplish for these companies.
In the world of like the studio, and then like angel investors, are you post angel investor? Are you in replacing an angel investor, or does angel investor come in after you, or is there any involvement at all?
Yeah, the angel investor is probably the most likely investor for us in these companies, because we're not raising, each round we raise is not huge. And so it's very palatable for a angel investor to participate in. And it's not as palatable for a VC to invest in because of their model. They either, they want several rounds to invest more and more money over time so they can take more of the cap table, and ours it just doesn't fit that model as much. So our ideal investor for any of our companies is an angel.
Yeah, and going back to what I was saying earlier, I can imagine an angel is much more comfortable investing in a company when they know, hey, 1845 is a part of it. They have a track record. They've been in this space for, they've had a lot of experience developing, building, and scaling, exiting companies. Like, I mean, that makes complete sense to me.
And our argument to an angel is, and me as an angel, I'm the co-chair of the North Texas Angel Network, and I'm the founder of the Park Cities Angel Network. So I'm involved in angel networks. And if you came to me and said, what's most important to you as an angel investor, I'd say, I want an entrepreneur who's done it before, right? I want somebody who's an expert in the space. I want somebody who's passionate and convicted. But the most important thing for me would be, has he or she done it before? Have they been through this? That adds a lot of credibility and a lot of trust on my side. So our thesis or hypothesis is that will make a difference to investors, and they will see that and say, well, gosh, it's good. Even if this founder, your co-founder, has never built a company before, you guys have, and so the fact that you're there should increase the likelihood that that company succeeds.
Yeah, I did a podcast probably about a year ago with Kevin Lavelle,
Hmm.
and it was interesting talking with him because obviously Ms. and Maine is this massive success story, and yet even though he has that massive success story, his new company Harper, he has to start all over, and even though he's had this huge win, it's still a painful process to raise money for it.
Hmm.
And that completely blew my mind. That, but I guess it's because it's a different industry.
It is, and your investors may believe in you, but they may not understand the industry, and so that may keep them away. And a lot of investors are going to continue to back Kevin for every company he builds, and they should. He's a great entrepreneur, but yeah, it's never easy to raise money, no matter how much money you've raised in your career, how many investors you know. I've never found it easy to raise money.
Right. So you talked about partnering, investing, bringing on a $2 to $3 million raise. What if it needs $20 million raise? Is that just outside of y'all's comfort zone, or it's like, hey, that's not necessarily what we're going for, and it doesn't fit the box that you're looking for?
So for us, we would prefer the model that we've built, right? 2 to 3 million, exited 100. But if the company requires a different model, right? If the company requires a major raise, or is just doing so well and growing so fast, a major raise is what makes sense. We have the freedom to do that if that's something that we want to do. We may take chips off the table in that process, right? We may sell, recap and sell part of our equity as we're growing it. We don't know. We haven't been there yet, but we're going to do what's best for the company and what's best for the founder. One of the commitments that we make to our founders is we're founder first. A lot of people say that, but we're founders. So if we're not going to be founder first for them, then we're not going to be founders first for ourselves. Doesn't make sense, right? So for us, the founder, and that's really what I think resonates with the companies we meet with, is that, and you can appreciate this because you're an entrepreneur, but like when you're around another entrepreneur and you hear him talk, you can sense whether she's an entrepreneur or not. Like you could feel it in the way she speaks and the things she says, even things that aren't related to business at all, you sense it. And so when somebody senses that you know what it's like to be in that battle, in that war, they have a lot of respect for you and a lot of appreciation because they know that you know what they're going through. So it builds trust that you're going to make the right decisions and help them make the right decisions to grow and succeed in their company.
Yeah. On the flip side of that, you could tell when somebody's full of crap.
100%. 100%.
So where did you come up with the 2 to 3 million as far as that's your buy box?
Yeah, so we just evaluated what we thought it would take to build a company to a certain level, and we thought the 2 to 3 million was a good fit. I think it's interesting when you think about venture in general, right? So much of the venture model is built around raise, grow, build, raise, grow, build, raise, grow, and it just keeps going. And the goal is, it's someday we're going to be worth $1 billion. Where most companies don't ever become worth $1 billion, and it doesn't work. Whereas in our model, it's different. When your strategy isn't how do I build, grow, and raise, your strategy is, okay, I want to sell between this number and this number. And in this market, these companies sell at this multiple. So I need to get to this number in revenue. And then you're like, so this number in revenue, based upon our pricing structure and cost, is this many customers. And your strategy is not how do I build, grow, raise. It's how do I go get 217 customers? Because at 217 customers, that number's hit, that multiple happens, and that exit is feasible and realistic. So you say that to an entrepreneur, and he says, "Give me the phone." Well, 217, let's go. 1, 2,
Mhm.
right? It's a different strategy. It's more like a high growth small business than it is a massive high growth, scalable company. But the plan and strategy to go accomplish that is just I'd say it's easier, not necessarily that it's easier to execute, but you know where you're going. There's no question about, well, one day will we be worth $1 billion? You go 217 customers.
Well, I think also this might be completely wrong, but if you say, hey, using the strategy you just said, it almost skips the J curve completely.
It
You know,
can. It can. But, it's still, you're also talking about doing it in 3 to 4 years, which is really fast. And so to hit that range, let's call that 20 to 30 million in revenue. That's not an easy thing to do for any company. It's definitely not easy to do in 2 to 3 years. So you really have to make sure that there's that opportunity and that strategy to grow, and then you've got to be capital efficient because you're raising 2 to 3 million. I mean, it's not an easy needle to thread, but it's one that where you need to go to get there, and so you build plans and strategies and structures to get you to that point.
it's funny because the 2 to 3 million, we're both a little bit older, so like, 2 to 3 million in the '80s, that's a ton of money, and let's be honest, that's a ton of money now. But if you back up a little bit, zoom out, you're like, wait a minute, that's only 20 to 30, $100,000 a year employees
Right.
before taxes or anything else like that. So when you think in those terms, just like, oh, that's not that much money,
Mm-hmm.
and then that 2 to 3 million is supposed to last the entire growth stage of to get where you're trying to go.
Well, yeah. If as I tell people all the time, if you go out and you start generating sales, it's the best fundraising you can ever do. So, you
Yeah,
know,
sales solves everything.
sales solves everything. So build and go sell the company, go sell the product and service that you have, go out there and do it, and then realize the benefits. Then you don't have to raise more money because I think we in the startup community, and this has been done by shows like Silicon Valley and just watching the successes of the Mark Zuckerbergs and the people like that of the world, is that we think, all right, you come with an idea, you go raise $1 million and you build this thing and then you retire with a gazillion bucks in the bank. My argument is, why would you ever raise money if you didn't need to? Right. So if we can build a model where we raise some money, get out in the market, start to generate sales, revenue, and profits, and then the second time we go out and raise more money, we're doing debt versus equity, that's an incredible opportunity, right? That's how you should be building. It's not about how much money can you raise, it's how much revenue can you generate and how much further can you take your business. So you got to think about it like that. Raising money is not the end all be all. It's a method for a company that fits a model of growth in that format.
Yeah, I think that topic it's coming to light recently because of that 24-year-old kid who raised, I don't know, 40 something $billion for
Hmm.
an AI fund, and then at his wedding everything imploded because it turns out you probably shouldn't give a 24-year-old kid billions and billions of dollars.
Hmm.
And but to your point of the raise is not the goal. The raise is
Yeah,
the fuel to get to the goal.
absolutely. And you got to think about too the benefit of there's never been a better time to build a business. I remember back in the dot-com age when people were like, "Gosh, technology's so amazing. This used to cost this much to build, and now it's only this." Well, now we live in this AI generation where not only can you build things for less money, you can build it more quickly, and you can manage your company with a lot less people because there's AI tools that can take the place and functions of what some of the people would you need to hire. So it means that your net margin should go up because you're not spending so much money on people. And so we build for each one of our companies, we build a customized AI tech stack. And it's basically what tools should they use to operate the business that minimizes the amount of money they have to spend on people, on processes, on anything like that, and creates an opportunity for them to grow more quickly, generate revenue, and be profitable faster.
The one thing, because we were just talking about sales and now we're talking about AI, the one thing that I have to remind myself constantly, and I oftentimes fail at, is sales solves everything, but AI is so cool, and you get into this hamster wheel and then this rabbit hole, and you're building solutions to problems that you didn't know you had, and oh, I can do this, I can do this. Like, did you pick up the phone and call that guy to make the sale? Because if you don't make the sale, you can't afford the AI.
100%.
And
Yeah.
I'll be honest, I fall in that trap daily where it's like, oh, I'm doing this, I'm doing that. And it's just like, but did you write that proposal? Did you close that deal? Did you
Hmm.
get Trey to buy your video package or whatever? And I think I can't be the only one that struggles with that,
Hmm.
because AI is so fun and so cool, but at the same time, if it's not making sales and it's not generating business, it's useless.
Right. Doesn't work. Business doesn't work. You don't sell, and it's going to be hard to replace the sales process. You can automate it. You can make it more efficient, but things that require in-person interaction are important, and hard goods will never go away.
Well, it's the common. I mean, I think every podcast I've recorded in the last year and a half there's been an element of AI won't replace you. Someone who knows how to use AI will replace you. And at the same time, as a startup, as a VC, like, you need to understand that AI is great, but if you're not using AI to perform a revenue generating task, it's a waste of time.
Well, and the problem that, and I have the honor to get to teach students at both SMU and at Highland Park High School, and what I tell them all the time is you may be better at AI than I am, but here's the difference between you and me. When AI spits out a product,
Yeah.
I know whether it's right or wrong. You have no idea. You just knew that you created a prompt and it spit it out, right? You've got to learn.
Critical thinking.
Yeah, and the only way you're going to get a lot of that is experience. And I mean, I see it daily. The amount of time it takes me to create things that I used to take longer time to create is incredible. It is so fast, but I also know what I'm doing, right? I
Yeah.
also can look at it and say, oh, that's wrong. We need to change this. Look at that. That's an important element that if students don't get the time, put in the time and get the experience, they won't be able to replace you or me, because the stuff they'll be building isn't going to be, they won't have any idea whether it's right or not.
Yeah, they probably don't have those moments where they're yelling at the computer going, "You're an idiot." Because I did that this morning. I was yelling at my Claude
Yeah,
because I'm like, "That's not what I wanted. I told you what I wanted."
right.
And it kept on, not, it wasn't hallucinating, but it was like giving what it thought it needed. I'm like, and I had to put it in its place. But
Did Claude apologize?
no, I
Oh,
don't.
okay.
But it is kind of funny. Circling back to the cap table aspect, because you say you're equal partners. So I have this idea. I come to you. I watch this podcast. I'm like, you know what, Trey? I have this widget idea. We're gonna be equal partners. Cool. I'm cool with that. We need to raise 2 to 3 million. What does the cap table look like then? Once we have that
The two,
the
3
VCs
million.
coming in.
Essentially 33, 33, 33.
Okay.
So the investors, LPs, have 33%. And this is if you were to raise $2 to $3 million
Right.
and exit at that level. 1845 has 33%, and the founders have 33%.
Yeah, but if you have a worthless idea without implementation, execution, and then 4 to 5 years, let's just or we'll just say 4 years,
Mm-hmm.
exit for 100 million. That's a good day.
It's a great day.
It's a great use of 4 years.
Generational wealth. Like, it's transformational for people to have that kind of money, either to continue building new things or to provide for retirement or for your kids. It's a pretty incredible world. And 33% of your I've never been a part of a venture investment that when I sold the company I had 33% of it. That's a pretty unique scenario. So we believe it is founders first, and we believe it is in the best interest of the founder. But again, we also believe it's not for everybody. And if it's not for everybody, then that's okay. Like, we don't need everybody. We just need 4 companies a year.
I think that's a conversation that most people don't have enough,
Mm.
which is if you look at like a Jeff Bezos or an Elon Musk or Steve Jobs or whoever, like, how much percentage of their companies do they own? And how much is it spread across? Like, even a Mr. Beast, I mean, I think he's 51% owner of his ventures now, or 49. I don't know what it is, but it's not 100%. So, like, most startups,
Yeah,
founders don't realize that 8% of a billion is much better than 100% of nothing.
correct.
You know,
That's the argument we make with people. And
I
it, like anything, like any job, like any client you have, you got to find right partners. If you find somebody that, even if they're willing to pay you for your services and you don't like them and it doesn't make sense, you shouldn't take the the relationship. So it's about people. It's about, as my business partner always says, we want to find people that we'd like to hang out with. Like, that's important to us. Like, if we don't want to hang out with you, we don't want to build a business with you. And the reality is, when you're building a business, you're hanging out with people quite a bit. And so, that connection that we need to feel with the company and the company needs to feel with us is an important part of the gel that's going to make something like that work.
Well, and again, it goes back to what I was saying at the very beginning of this is like, it makes sense to me being in the entrepreneur space of, and we've had revenue, we've had our ups, we've had our downs, but it's like having somebody who come in early and go, hey, we're going to help shield you from those cuts and
Hmm.
bruises and those broken limbs, and just like, we're going to put you on the fast track. Because, I'm 6 years into this, and it's like, wait a minute. And obviously video production is not $150 million exit, but say I was a part of something like that, hey, we're going to give you this trajectory. Here's the roadmap for 4 years from now. Like, that's an easy sell, but that's because I've been
Right.
through it.
Right.
But if I'm a 25-year-old, I'm arrogant and I know more than you because ChatGPT told me I was right.
Correct. Which ChatGPT always tells you you're right. Honestly, that's perfect. Is
Yeah.
what ChatGPT says.
It's like, that's when you say, bless your heart,
Right.
follow your heart.
Right.
So who are your investors? Who do you work with? Like, because you say your 1845 investors, they get first right of refusal for your network. And then you were talking about you're part of 2 angel networks here in Dallas.
Hmm.
Is that pretty much where you're going to for your piggy banks?
So yeah, interesting. We're going to a lot of places. Interestingly enough, the angel networks I'm a part of don't typically invest in pre-seed. So we probably go to the angels directly, not through the angel network process, because we like to see companies that are a little further along. But I'm building out a 500-person database of investors, of people who I know want to invest in early stage pre-seed type deals. And then we're just going to build that network and go to those people. And that's what we'll do to raise. And then, and if the companies that we're building now start to succeed, then raising capital for the next set of companies will be easier than it was this time around. But it's also part of telling a good story and getting good founders and good companies out there, and get in front of the right people that would want to invest. But you know, angel networks are a unique scenario that I probably wouldn't go to a network day one. I would go to the angels inside of a network that I knew.
Can we go into that a little bit? Just because you brought up the angel network process. What is that, a thing, or what is that?
So, and I say this to people a lot because I think it's important. Um, y- they're Most people, when they run a process for raising funds, they're not really efficient in it, right? They're just trying to find investors. They're not looking at, does that investor invest in this type of company, right? And so founders waste a lot of time going to investors who'd never invest. So if I was a healthcare investor, and then that's all I like to invest in, and somebody pitches me on a space company, I'm not going to invest. And you
Yeah, did
shouldn't
you
think
do any
you're not
research
going
at
to
all?
you're not going to change my mind to invest in space if I don't invest in space. So what I encourage founders to do is look at the angel networks that you're going to. First of all, read their thesis. What do they invest in? The number of companies that apply to our angel networks that either don't care or don't read our thesis is fascinating to me. Just because, again, I feel like they're not using their time wisely. Next, I would look at that angel network and see what deals have they funded recently. Because an angel network is made up of individual accredited investors who get to choose whether or not they want to make an investment in any deal. It's not a fund where the angel network makes the investment directly. Now, there are some angel networks that build sidecar funds or SPVs and things like that. That's separate, but the angel network in general doesn't do that. So you need to look at the angel network. You need to see what kinds of companies they've invested in, because that'll let you know what kind of angels they have. And if you look at something and they're not investing in space, and all of their investment in the last 2 years have been CPG related investments, then that's not a good place for you to spend your time. Where angel networks are awesome is when you've got some traction, you're starting to work, it's starting to grow. They have syndication partnerships, and so One of the things we love at Angel Network is when somebody comes to us and says, "Look, this company is raising 3 million. They've raised 2.75 million. They've got a little bit of room left. Here's all the diligence we did on them, like all the things that they've already done." It behooves them to share that with our Angel Network because we may be able to help close the round, because an Angel Network or an angel in general is usually not going to invest and take the whole round down. They need other investors. And so the smart angel networks are out there saying, how do I partner with all the other angel networks to close out my deals, to find good sources of deal flow, and then make sure that we're investing in those deals that are moving in the right direction. So that's how typically angel networks are nonprofit organizations. They're not licensed investment groups, so they can't. An angel network should not and would not ever tell you should invest in this company. Their job is to look at the companies, make sure the companies, the things the companies are telling you are true, do some evaluation on the companies, start to narrow down the companies that they think have the best possible opportunity, and then present those to the angels in the group, and those angels decide yes or no individually themselves.
I only have my personal experience with like an angel. I've never dealt with an angel network. So how big are the checks are they writing? Is it $5,000? Is it 50 grand? Is it 5 million?
So it depends on the angel network and the angel. But typically we see them writing checks from 10 to 25 to maybe 150, maybe 250. Occasionally you'll see somebody write a $500,000 check, but most of them are sort of in the 25 to 150K range.
That makes sense to me now because, like, again, I don't have that much experience with I don't have any experience with Angel Network. And when I heard somebody was talking about, oh, I like to write checks in 10 to 15,000, like, I was confused because what is 10 to 15,000 going to do? Cover payroll, one payroll period, maybe buy some stationery. I mean, it doesn't, but if there's 10 of them,
right?
If there's 100 of them writing $10
Right.
to $15,000, that's a different story.
Totally.
And I never. Thank you. That makes me feel like I've learned something today.
And the other thing that that for people who are aspiring angels out there, like who are accredited investors that want to get involved in the angel game, I'm very specific with them too. If your goal is to come in and write 2 to 3 checks, maybe invest in 4 companies and move on, don't do it. That model doesn't work, right? What the model that works is you got to invest in 20-something companies.
Right.
And that historic data says that those investors are going to generate a 27.5% IRR return, which is a great return on your investment, but only if you truly diversify.
On the total investment, not just the single one.
Correct. Only if you have 20 to 30 different companies.
Because that singular investment might be a 3,000% or whatever.
Right.
Yeah.
It's just like the venture capital model. They invest in 50 companies and 2 or 3 work and a couple of them do okay. And so it is a bad move from an angel investment perspective to come in and only invest in a couple of companies. And if that's your strategy, don't do it. I tell people my advice, and counsel is a good place to start, is take 2 to 3% of your net worth. So I'm not suggesting people invest a ton of money in early stage. Take 2 to 3% of your net worth and then take whatever that dollar amount is and spread that over 20 to 30 companies. If that's $2,000 per company, that maybe you shouldn't be doing investing. It doesn't need to be $500,000 per company, but a 10, 15, 25,000, $50,000 check in a bunch of different companies, historically, statistically, is a good win. 3 investments, you're probably going to lose all your money. And so you got to understand what you're going into as well.
Yeah. The conversation I had with my angel investor was like, Ryan, I don't think I'm ever going to get this money back.
Yes, and they have to.
But I believe in you, and I want you to succeed. So here you go.
And they sign documentation that says, I recognize that I could never see this money again. I also tell people if writing a check is going to cause you massive amounts of anxiety and consternation, don't do it. Right? Like you got to recognize that you may not get this money back. And if you recognize that and you go in with eyes wide open and you do it in a smart, strategic way, the chances that angel investing is going to provide a great return and also an unbelievable amount of fun, right? It's just a blast for so many people that, not all angel investors are entrepreneurs. A lot of them are corporate men and women that have made good money, or consultants or lawyers or whatever the case may be. How fun is it to get to scratch that creative itch that you have, like getting to feel entrepreneurial without having to leave that job that's paying you pretty good money every 2 weeks consistently. And so there's a lot of benefits to being an angel investor and being involved in that space. Just helping companies succeed is
Yeah.
really exciting too. So
Was one of my favorite stories with my angel investors is like after he came on a week later, we were doing an interview with the Governor Abbott, and he got to come and hang out in the room. So it was literally the guy that was interviewing Governor Abbott himself, one state trooper,
mm,
myself, Paul, and then my angel investor, and that's the only people in the room. So it's like I haven't given his money back yet, so financially it probably wasn't a good choice, but he gets to do cool things.
yeah, and people invest for a lot of different reasons.
Yeah. So going back to we touched on it a little bit, but we went straight to other topics. The need to filter and research who you're asking money from. Because talking about angel investors, if somebody's only does space and you're asking for oil and gas, it's like, did you even do your homework on me?
Right.
Like you do that too many times, your email will go straight to spam
hmm
and your phone number gets blocked. And I don't know if people fully understand that.
They don't. And then, and bless their hearts, those entrepreneurs, like they just assume, wait, but when you hear my idea,
And you have all the money, so
yeah,
you should give me some.
when you hear my idea, I know you don't like space, but when you hear my idea, it's going to change your mind. And that's part of the exciting thing about entrepreneurs, is that they truly believe that they're going to change somebody's mind. They truly believe that if they can just communicate what it is they're building, it doesn't matter who you are, you're going to want to be involved. And it's just not true. And it's wasting the investor's time, but it's wasting your time, right? Your time is valuable too. And so you've got to be thinking about, how do I use my 24 hours every day before I run out of money and this thing doesn't work? And spending it on investors who shouldn't say yes, aren't going to say yes. It just isn't a good use. You're already going to have enough people that are going to say no that may be directly in the right space for you. So you gotta think through that and research that, and be very, very. I mean, it's sales. It's a sales process like anything else, right? And you just got to be very thorough and thoughtful and researched on whether or not somebody's a good fit for you, and then also understand some people are going to say no that you think they're wrong. And for most of us in the entrepreneurial space, a no is better than a maybe, or I'll get back to you. No is super helpful. Great. Go to the next one. Go to the next one.
Right.
Go to the next one.
Well, cause one of the things I'm working on right now is private lunches, like helping people out, because like one of my clients is looking to raise 30 million for his data center energy company, and he knows the last 2 years I've been doing a lot of networking, Old Parkland, SMU, and this and that. Now, the one thing I'm not going to do is send a blanket newsletter email to everybody, because one, it's probably illegal, and two, it's I'm not a lawyer, so nobody come after me. But two, you're going to burn your list. It's like if I'm hitting you up every time, it's like, hey, I got this opportunity, I got this opportunity. And you're
Right.
like, I get it, you get a lot of opportunities, but if I come to you saying, hey, Trey, here's something that I think is a good fit for you. If it's not, just let me know. But if it is, well, I can help you out
Right.
with that. And but that's the power of the connector.
Of
you
the
know?
network. Yeah. That's
Yeah.
where it's valuable. And the double opt-in for me is so important. I don't go to people, and if you ask me to introduce you to somebody, I'm not just gonna connect you. I'm gonna go to that person and say, would you like to meet Ryan? You should talk to him. I think there's something really interesting here. I think it's a good fit for you for these reasons. I think it adds value to you for these reasons. Are you open to an introduction? It takes a lot of time, but it saves the network,
Right.
as opposed to what happens to me a lot, which is people just assume, well, Trey's an entrepreneur guy, so anything involved in entrepreneurship, I should send to him. And so I spend a lot of time, in meetings or responding to people saying, that I don't have time, I can't do this, or I don't invest in these things. So what I do, which is super helpful, is I tell anybody that wants to reach out and meet with me, um, send me a deck. I'm going to look at the deck. You don't want me, because everybody wants to have a call or a meeting or a coffee. And you don't want me to come to a call or a coffee or a meeting without having looked at your materials, because you're only going to get the value I can add to you for whatever I'm thinking about in that moment when you tell me your idea. You don't know how many meetings I've had that day. You don't know what I'm dealing with. You have no idea. So you're getting this little snapshot of time hoping that I add value. Versus if you send me your deck, if you send me information on you and I can read it, then one of two things happens. Either A, I come to the meeting prepared to add value, or B, I can tell you right from the get-go, this isn't a good fit for me. I'm not going to invest in this. I'm not the right person to talk to. Maybe contact somebody else. Saves me time, saves the entrepreneur time, and allows me to add value in a way that I couldn't if we just sat down and you said, here's my idea. Because most of the time, I'm going to say, whatever your idea is, I'm going to say, that sounds like a great idea. I don't think it'll work, because most businesses don't work. And so you've got to have the opportunity to think through and understand the entirety of the company, the process, the initiative, the problem you're solving. What research have you done around the customer, validation process, which I talked about earlier? That's exceptionally important.
The introductionary etiquette, the connector etiquette is, it took me a while to really understand it and kind of buy into it. But I think that comes when, as you level up your network and understand, oh, wait a minute, everybody's special, everybody's important to somebody. But at the end of the day, once your network starts really elevating, and you're like, you will lose access to those people if you burn it.
Absolutely.
And one of the things like I've started doing is, like, if somebody's like, hey, introduce me to Trey, I'm like, oh yeah, no problem. What for what? Oh, I want to send him this thing. Is like, well, if it's a solicitation, I don't feel comfortable with that.
Right.
If you want to take him to a football game, yeah, cool. Here's an email. But if it's somebody that I know that somebody would want to meet, I'll do a group text.
Yeah.
So I think it's just kind of evaluating where somebody's at. But at the same time, I did this earlier this week. It's like, hey, I hear somebody that's important. I know that y'all can connect and could be doing good things. What's the best way to connect?
Right.
Hey, email, because if you text, it'll get lost. Perfect. And then that's the way it went. But again, though, I think the etiquette aspect, a lot of people don't fully appreciate.
It's very important.
Yeah, especially when you're on the side of like, no, like,
Yeah.
because I've started, I don't intend to annoy people, but like, I'm not, do you know a gentleman named Trevor Hightower?
Yeah.
So one of the things that he told me was, one of his mentors gave him was, encourage everyone, advocate for a few.
Mm-hmm.
And I've been bad, and bad is not the right word, but I've had a habit of advocating for everybody.
It used to be my job
without being paid for it.
Yeah. That used to be my job at the deck, was advocating for everybody. And for a time, that was what I did. And that was great. And I would meet with any entrepreneur at any time for any reason. That's what I had committed to do. That's what the deck was about. And now that's not my role anymore. And that doesn't mean I don't want to help people. It just means I'm going to do it different ways. That's why I created the Investors in Trucks program that I created. It's just giving little bits of advice to people that I've learned over years. It's why I write blogs occasionally. It's why when I get asked the question enough times, I'll write a blog on it. And what I'll tell people is, they'll say, "Oh, can we meet?" And I'll say, "What do you want to meet about?" And they'll say this. I'll say, "Oh, I actually have an article I wrote about that." Read the article, send me some questions or what you think about it, and I'll have coffee with you. 98%, 99% of people I never hear from again. But they would have had coffee or gone to lunch with me had I said yes. So all I asked them to do was read an article that I thought would answer their question anyway, and just let me know that they read it. And they don't even do that. So you've got to, people don't know this, but they want you to do the work for them. They want you to raise the money for them. They want you to give them, and I get this question, I laugh all the time. People go, do you know any investors looking to invest right now? And I always say, yes. It's so funny. There's a line of 10 people standing out of my office saying, do you have anybody I can write a check to? The answer is absolutely. I don't know a bunch of investors looking to invest. Tell me what you're looking for. Tell me what type of investment it is. Give me specific, ramifications of what you're trying to do, how you're trying to do it, and go look at my network and figure out who in my network match that, and come ask me to make an introduction to that person. Not, do you know people that want, and people don't mean badly. They just,
Right.
they don't understand the process and how to do it. So we can help them do that, and we can help communicate the most efficient and effective way to do it. Again, with the goal of saving the entrepreneur time, not that it's annoying to an investor or it's annoying to have somebody bugging you to have a meeting with them. That's not, I respect entrepreneurs who ask for those meetings. I respect entrepreneurs who stand up in the middle of a session in the Q&A and pitch their company. Now, I'll stop them and say, that's not what we're doing here. You have a question, you have a question. But I mean, take your shot, man. Like, I respect the fire out of the plight of an entrepreneur, because I am one. But I also want to help them be efficient with their time and have the maximum possible return for the stuff that they're trying to do.
There's so many rabbit holes, forks we can go from
Mm,
just then. But one of my biggest pet peeves, it's not really necessarily a pet peeve, but helping people. Like the amount of times I've invited people, like, hey, I've got this thing, I've got this event, would you like to go? And they're like, well, no, I'm busy. There's somebody I offered to, like, hey, go to this happy hour. I can't. And like, the amount of times I've said, here's an opportunity, but you hit the nail on the head, which is they want somebody to do it for them, because they don't understand that maybe this opportunity here can get them closer to the objective they
hmm
wanted, but that means they have to go do that.
Right.
The coffee thing, I mean, I still go to a lot, but I'm trying to be better about saying, hey, every Thursday I'm at this place for coffee, happy hour. If you'd like to join me, join me.
Yeah.
It's an open invite.
Yeah.
And I have a place I go to, and I've told multiple people, I put it on the internet. I don't want to do it here because I don't necessarily want to dox it, but no one ever shows up.
Yeah.
And you would be surprised. Like I was at, like, even last night I was there and, oh, I can't go. Okay, cool. And I'm by there by myself reading my book. And then I run into like a hedge fund guy that I know, and I'm hanging out with him and his friend who's a private wealth banker at Wells Fargo,
Yeah.
and we're hanging out for about an hour, just having a great old time. And it's like, you couldn't buy that access. And here it is.
hmm
And I've tried to explain that to people, but they just don't,
Mm.
you know? So the helping themselves aspect. The other one, my biggest pet peeve that you hit on, is when you are in a Q&A session, just ask a question. Like, I was at an event this early this week and somebody spent 5 minutes explaining his plight and it wasn't even a question. And then literally there was no more questions because he ate up the entire
Yeah.
Q&A time.
Yeah.
I
It,
hate that.
it happens.
That has nothing to do with venture capital, but it
Well,
kills
it
me.
happens. Well, I'll usually say before the talk begins, I appreciate that is your perspective and that you've got the guts to stand up and pitch, but if you do it, I'll stop you. So just setting the ground rules for how we're gonna operate this session, and that's okay, and people usually respect it. But
So going back to 1845, where are you currently getting your deals and where do you foresee getting your future deals?
so I used to work at a global investment firm called Techstars and ran a couple of programs for them. I sourced 5,000 companies per program to start. And then I'd start with 5,000 and I'd go through them. I'd knock off 3,500, get down to 1,500 or 2,000. Then I'd send out email communication to those and say, I want you to participate in our program. Deal flow is not a problem, right? If you go out and you go try to find deals, you're going to find deals. And so for us, we just communicate, send out an email, post some stuff online, and we get some great, interest from people. um, because of our networks and just because we've done this before. That's where we're finding deals. We're also finding deals from referrals. We're finding deals from, just hearing about things and seeing different things. But it comes from a lot of different places.
I would assume also that just the visibility of being an instructor at SMU, Impact Fund, Highland Park, podcasts, all the angel networks. You're probably constantly bombarded with opportunities.
We see a lot of companies. So, and again, not that we're not grateful for, or that we don't have to work to find companies. We do, but that's not the biggest issue that we have in building these companies is finding them. We've finding good ones is hard, or finding ones where we can add value is hard. But it just, it's just time. Every bit of it is time.
What is the biggest issue?
I think the biggest issue is that 90% of startups fail, that what we're doing is hard, that um, that the likelihood of success is, no matter how many, you're not guaranteed success because you've built 30 companies that worked, right? My first failed company was 2021, and I built 35 of them. So just because you built 30 doesn't mean 31 is going to work. And there's lots of different reasons companies don't work. And this could be my fault. It could be other faults. It could be market forces. It could be a bunch of different things. But that's a hard part, right? That's a hard part to stick with it and persevere long enough to get the company to a place where it's actually growing and succeeding. I mean, I think it's also the fun part, but that's, building companies is hard.
So because it's a partnership with the founder and you have all this experience, do you foresee a time when you're like, guys, this isn't working, it's not going to work, but the founder's like, I hear you, I respect you, but I still got fire. What do you do at that point?
That's an interesting discussion. I think every situation is different, but for me, I think the answer is, if he or she wants to continue going, and there's not, you know, uh, financial liability to the company or legal liability. I mean, if it's just he or she wants to keep working on it, then I'd be fine with them doing it. I may say I'm going to quit working on it, which doesn't change the
Right.
amount of equity I have. It just means I'm at a different place than you are. But usually you come to the same conclusion on things like that.
And then that also opens up a door of another conversation we haven't had is because it's equal partners and it's their vision, their idea, who has the final say in debates?
So we build a board, and the board has, people from their company, people from, the founders. It's got 1845 has representation. There's usually an independent board member. But the idea is that if we're partnering with the right partners, then we're going to be very, fluid on the process for making decisions and working together and coming to conclusions together. So it's very much focused on a partnership where you're going to need to make a decision as a team.
Coming to the end of this conversation, we talked about Texas and how Texas isn't really known for billion-dollar exits and startups, a lot of 100 to 300 million tech companies. What do you think is the trajectory of startups in the VC community within Dallas?
Well, so I have a theory on the exits in Texas, and my theory has been we have a lot of 100 to 300 million dollar exits. Like, I know that's not a theory because I've seen them and I know about them, and I always tell people, you want to know how good of how good this environment is for venture, talk to the lawyers and the accountants. They just can't talk to you, right? They can't tell you how many companies is exited. They've got confidentiality issues. But I think because of those exits and because they're happening from corporations and the corporations are not touting those stories, we're missing out on a lot of opportunity to tell the stories of the wins. And so that's been an inhibitor for us. I think that if New York or Boston or as San Francisco knew how many exits were happening, we'd have a lot more venture capital firms here. So I think there is opportunities to grow in different ways. I think the more exits we have in the community, which I think we're going to see, more and more that are a little bigger. which will be exciting. And I think the bigger exits are the ones that'll attract more capital. I think if we ever had several big ones, I think it would open up family office capital in a way that hasn't. But I also think we're in an interesting place, and you could probably speak to this, but we're in an interesting place with family offices in that many of them are Gen 3, Gen 4, Gen 5. And, you think about the history of those family offices. A founder, a matriarch or patriarch, made the money. And then they hired a group of people younger than them to build the wealth preservation, wealth accumulation strategies, right? Those people created that strategy for the family. Then you go to the next generation, Gen 3 or Gen 4, and they're executing wealth accumulation, wealth preservation strategy, but they didn't develop them. So they've gotten to develop nothing. No creativity. The best way for them to get to do something fun would be like, let's take 2 to 3% of our net worth and go do something in venture. Let's start by doing some fund-to-fund investments. Let's look and, dangle our toes in the idea of direct early stage stuff. Let's pull together a fund of 20, 40, 50 million and go hire somebody who's really good at this to come in and do that. I think we're going to start seeing more of that happen over time. And I think that's going to change the venture climate. But I think with all the momentum that's happening here, we're just going to see more and more great stuff happen. And I would argue that a couple things. One, you don't have to raise money from Texas. Two, that's changed since I've been here. When I came here originally, when I moved back in 2008 or 10, if you wanted Silicon Valley money, you had to move to Silicon Valley. That's not the case anymore. COVID changed that, right? If a Silicon Valley investor is going to invest in you, they're going to invest in you whether you're in Dallas or somewhere else, which is great. Second of all, good companies raise money. When I talk to my friends who've raised a lot of money in DFW, and I say, how hard was it to raise money? And they're like, oh, it wasn't that bad. Really, why? Well, we had sales, revenue, and profitability. Good companies raise money. So a lot of times when you hear people whine and complain about how there's no capital going into early stage companies in Dallas, maybe it's because your company's not ready for capital.
Well, I think with the family office aspect, I think you're probably right, but it also take a fundamental shift in how they run things. Because the thing that I consistently hear is there's two rules in family office. Rule number one, don't lose any money.
Right.
Rule number two, don't tell anybody how much money we have.
Yeah.
And because like I have this theory when it comes to the private equity, venture capital, family office world is all three of those are, at least on the capital side, historically very private, very quiet. And obviously, even with trying to do this podcast or the private equity show or the deal table, I'm trying to buck that because nobody else has. Because I believe in 2026, you need to be private on certain things, but there's such a demand for attention that you're not going to go viral. Just because you put something on the internet, no one's going to see it. You have to try to get their attention. And as deal flow and capital gets harder and harder and more competitive, the only way you're going to be able to compete is if people are even aware that you exist. So even if you are this giant family office, the best way to compete is, yes, with your wallet, but also having attention and credibility and authority. And I believe fundamentally that media can help with that. So to dovetail into what you were saying about family office tipping their toe into more venture, I think they should also tip their toe into media.
Yeah, absolutely.
So I think with that, we could probably close because that's kind of a sales pitch to you and a sales pitch to me.
There you go.
So is there anything else that we didn't cover that you'd like to kind of, final thought on?
Yeah. So, I just think, again, it's just an amazing time to be in Texas. I think we'll invest in companies from anywhere. But we love the opportunity that exists here. And I think, I always encourage people to figure out, what are you doing to help the ecosystem grow? Are you connecting people? Are you mentoring people? Are you investing in people? Like, think through things like that. And play your role in helping them. Again, I tell people, the two great things about being in Dallas is if you and I went to lunch and I said, hey, I've got this idea. In Dallas, Fort Worth, we say, you should do that. You should do that. Not here's 25 reasons why it won't work, and that is never going to happen. It's you should do that. And the second thing that we would say that makes us super unique is, how can I help you? And then we do. We help you. Like, We help each other. We love seeing each other succeed. I never had that environment when I was out in the Valley, right? Never had that environment like this when I lived in New York or any of these other places. So that's substantially different. And it's an unbelievable opportunity. And so I just always ask people, please do what you can do to support this community and get out and help companies grow, because we'll all win, because a rising tide raises all ships. And a win for a company selling in Fort Worth is a win for a company in Melissa, and a win for a company who raises some capital in McKinney is a win for a company in Dallas and Frisco. So it's all supportive of each other.
And I think you bring up a point there, and I know I said final thought, but it's a worthwhile thing to bring up, is the asking for help. We recently did a podcast with Neil and Youngblood, and the biggest takeaway from that episode was, if you're in front of the president, have an ask,
Right.
because here's the most powerful person in the world. If don't lose that opportunity to say, hey, can you help me out on this thing? Now, obviously, 99.9% of us are never going to be in front of the president of the United States. But if I'm in front of Trey Bowles, what is my ask to Trey? What is my ask to Ryan? What is my ask to Steve, Scott, whatever? So it's not necessarily, beg and plead and grovel, like, please, can I have some food?
Yeah.
But it's like, have an ask and be
Right.
concise with it, and not just because when it's not necessarily asking for help, but also if you ask me, how can I help you? If I have an answer ready to go, there's more likelihood that that's going to happen versus hey, how can I help you? And I'm like, well, well then I'm going to get So, so I think there's two lessons there. Is one, ask for help, but when somebody does ask you, hey, how can I help you? Have an answer to that.
Yeah, that's great.
I wish I could claim it was mine, but Trey, thank you so much. How can I help you? Is there anything I could do for you for 1845 for Impact?
Yeah, I mean, I think we're just trying to find people that want to be involved in the ecosystem in every way, and fortunately, because we do a lot of stuff with SMU Impact Lab and 1845 and the Angel Networks, there's lots of opportunities to plug in and be helpful. And so, I'm always looking for talent. I'm looking for mentors and advisors, and I'm looking for capital for our companies. So those are the things that we're trying to do and trying to accomplish and help be a part of the great things that are going on in DFW.
Excellent. Well, thank you, sir.
Thank you.